Should you invest in Warren Buffett's company, Berkshire Hathaway, instead of the S&P 500? Conventional wisdom tells us to invest in the S&P 500 because it gives us diversification, where you are investing in the top companies in the US, and it has a proven track record of doing well over the long term, giving a 10% average return over time. However, many of the qualities that the S&P 500 have, Berkshire Hathaway has it too. It is well diversified, focuses on US businesses, and has delivered an exceptional long-term performance as well. In fact, Berkshire has outperformed the S&P 500 over many decades. Since inception, Berkshire has delivered close to 20% annualized returns, roughly doubling the returns of the S&P 500, even when dividends are accounted for. Not just that, over the past 1 year, while the S&P 500 only gave around 9% return, Berkshire also significantly outperformed it by delivering a return of 32%. So, given that Berkshire consistently outperforms the S&P 500, should you invest in it instead of the S&P 500? Let's find out in this video. Now, one of the biggest reasons Berkshire has outperformed over the decades is due to Warren Buffett's value investing strategy and his ability to buy great businesses at fantastic prices. Berkshire wholly owns 70 companies which span across many different industries. This includes companies in the insurance business, utilities, energy, railroad, clothing, food, real estate, and more. Many of these businesses provide essential goods and services that people rely on every day. That makes them not only resilient, but also recession-proof, as they will also tend to do well during economic downturns. This broad diversification helps Berkshire generate steady cash flow, regardless of market conditions, which is reinvested back into the company to drive long-term growth. Over the past decade, Berkshire's total revenue has nearly doubled from around $210 billion to well over $410 billion. Besides those wholly owned companies, Berkshire also has significant investments into publicly traded American companies. He owns Apple, American Express, Bank of America, Coca-Cola, and so on. Both his wholly owned companies and publicly listed companies have steadily contributed to Berkshire's growing earnings and free cash flow, which are then reinvested back into the company or being added to their cash pile. And speaking of their cash pile, it is on an absurd level altogether. As of the latest reporting, Berkshire's cash pile has grown to $347 billion and represents almost 30% of its total assets. In fact, the cash pile is larger than the market cap of many of the S&P 500 companies. Like Warren Buffett could outright buy the entire McDonald's and get free McLausai for the rest of his life if he wanted to. But of course, that's not his style. Instead, he waits patiently to buy great companies at the right price, which undoubtedly will continue to fuel the ever-growing earnings engine that is Berkshire Hathaway. In the meantime, he's returning value to shareholders by using some of the cash for stock buybacks. But he's not doing it blindly. Instead, he only repurchases shares when he believes that they are trading below their intrinsic value. So when you combine everything together, the resilient and diversified operating businesses, the strong public equity portfolio, and the massive cash pile that gives them the flexibility to seize opportunities during market downturns, you get a powerhouse that's built for both stability and long-term growth. Quick pause. If you want to assess whether a company such as Berkshire Hathaway is worth investing in, a great place to start is the Moomoo app. With Moomoo's smart investment tools, you will find a wealth of useful information. For example, you can get a quick overview of the company's valuation level with Moomoo's company valuation tool. With this, you can quickly assess whether a company's current stock price is cheap or not. This ensures that you are not overpaying for stocks. Besides that, you can also check out analyst ratings to see what Wall Street analysts think about the company, alongside with detailed explanations of their ratings as well as their track record. And for additional insights, you can check out Morningstar ratings. This is a paid feature, but it's available for free on the platform. It's one of the main sources I rely on for doing investment research. Otherwise, if you are into technical analysis, Moomoo's Smart Analysis tool is a game changer. It helps you track current market sentiments, money flows, and results from various technical indicators, along with potential buy and sell points. New users who sign up to Moomoo Singapore will get to earn up to $820 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. However, even though Berkshire Hathaway has far outperformed the S&P 500 in terms of annualized returns, it actually underperforms whenever the market is doing well. For example, in 1999, when the S&P 500 was giving close to 20% return, Berkshire dropped by 20% instead. Then in 2003, when S&P 500 gave close to 30% return, Berkshire only gave half the returns. You can see this happening over and over again whenever the market is doing really well. The reason is because most of the companies Berkshire invests in aren't fast-growing companies, but rather stable cash-generating businesses like insurance, railroads, consumer staples, and banks. Because of that, the key to Berkshire's success lies in how resilient it is. Here, you can see that during market downturns, Berkshire tends to hold up better most of the time. For example, in 1980, when the S&P 500 was down by over 10%, Berkshire was up by 10% instead. Then in 2000, during the dot-com bubble, Berkshire gave close to 70% returns. Then in 2022, Berkshire also held up much better thanks to its energy operations, cash reserves, and emphasis on low-risk business lines such as insurance and consumer staples. Even now, when there's tariff tensions and recession fears, Berkshire continues to chart along steadily. This shows how resilient Berkshire is whenever there's fear and uncertainty in the markets. But then, given that Berkshire is led by Warren Buffett, and let's face it, he's no longer young, and unless he has eaten Tang Shanzhang meat, he won't be around forever. So the big question is, can Berkshire continue to perform well after he's gone? This is a very common question. In fact, he was asked this during one of his annual shareholders meetings, and here's what he said.
We'll do just fine. We've got a wonderful group of businesses. I've told you the two things I do in life in terms of the managers we have. You'd have to come in and really want to mess it up, I would think. And we don't have anybody like that in terms of succession plans at Berkshire. And then there's the question of allocation of capital. And you can do worse than just adding it to some of the positions that we already had. The ownership, if I die tonight, the ownership structure does not change. So you've got the same large block of stock that has every interest in having good successor management as I would have. I mean, there would be no greater interest. And it's not a complicated business. I mean, you ought to worry more about, if you own Microsoft, about Bill Gates, I think, or something of the sort. But this place is, we've got a group down here that are running. It is one hell of a business, though, we've got here. I mean, if you saw what happened at Berkshire headquarters, you would not worry as much. There's very little going on there that contributes.
Contrary to popular belief, Berkshire isn't just run by Buffett alone. Instead, he has a team of lieutenants to help him with his business. For example, Ajit Jain has been with Berkshire for close to 40 years and has been overseeing the insurance operations. Ted Weschler and Todd Combs are involved in portfolio management. But more importantly, Greg Abel oversees most of the company's investments and has been named as a designated successor. Buffett has spent years grooming his successors and putting the right people in place. And because of that, he is confident that the business will continue to do well after he's long gone. But then, given that Buffett regularly recommends people to buy the S&P 500 and not Berkshire Hathaway, doesn't that suggest he might have more confidence in the broader market than in his own company? Again, here's what Buffett has to say about this.
S&P 500 index fund and have for a long time to people. And I've never recommended Berkshire to anybody because I don't want people to buy it because they think I'm tipping them into some side. Never. I mean, no matter what it was selling for. And, I've made it public. On my death, there's a fund for my then widow, and 90% will go into an S&P 500 index fund and 10% of Treasury bills. And on the other hand, I'm very happy having my future contributions to a group of charities that will be spread over 12 years or so after my death to stay in Berkshire. I think the odds are Berkshire is, I like it, but I do not think the average person can pick stocks. We happen to have a large group of people that didn't pick stocks, but they picked Charlie and me to manage money for them 50 or 60 years ago. And so we have a very unusual group of shareholders, I think, who look at Berkshire as a lifetime savings vehicle, and one they don't have to think about, and one that they'll look, if they don't look at it again for 10 or 20 years, that will have taken care of the money reasonably well. But that I wouldn't argue that the S&P 500 over time. I like Berkshire, but I think that a person who doesn't know anything about stocks at all and doesn't have any special feelings about Berkshire, I think they ought to buy the S&P 500. And
essentially, what he's saying is that he consistently recommends the S&P 500 for most investors, isn't because he believes the S&P 500 is better than Berkshire Hathaway, but rather it's because he understands that most people don't have the time, interest, or expertise to analyze individual companies, let alone a complex conglomerate like Berkshire. For the average investor, the S&P 500 is a simple, low-cost, and effective way to build long-term wealth. That said, Buffett still believes Berkshire is well-positioned to perform strongly over time, especially for those who understand its unique structure and strategy. Okay, here are my thoughts. Even though Berkshire has outperformed the S&P 500 over the long run, it's not a good replacement for the S&P 500. Not just because the average investor won't be able to analyze individual stocks, but also because Berkshire lacks the broad diversification that the index provides. While Berkshire is highly diversified internally, in the end, it is still one company, whereas the S&P 500 gives you exposure to 500 of the largest companies across all sectors in the US, despite the fact that it's heavily tilted towards tech. Not just that, with Berkshire, you are also relying entirely on the expertise of the investment manager to pick good stocks, which sometimes may not always be the right choice. For example, they invested in Paramount, which has likely cost them around $1.5 billion in losses. Then in 2020, they bought into airline stocks, only to reverse costs and sell them shortly after. During that time, they could have been buying high-quality tech companies at deeply discounted prices during the crash. Similarly, in 2021 and 2022, while many top-tier companies like Meta, Netflix, and Amazon were trading well below their intrinsic value, Berkshire largely sat on the sidelines, despite holding a massive pile of cash. However, with that being said, this is probably one of Berkshire's biggest strengths as well. Their investment strategy has always been not about chasing after the next hottest thing or timing the market, but rather it's about investing within his circle of competence while prioritizing capital preservation, discipline, and long-term value, even if it means missing out on some opportunities. This means that even though Berkshire isn't a good replacement for the S&P 500, it's actually a really good defensive stock to own, especially if you are comfortable with their investment style. However, I would also point out that Berkshire Hathaway isn't only the strong defensive stock out there. There are companies that not only offer downside protection, but are also capable of delivering impressive long-term growth. One such example is S&P Global. The company has established itself as a vital part of the global financial system through its credit ratings, benchmarks, and financial data services. This makes its business model highly resilient, even during economic downturns. At the same time, S&P Global is able to continue achieving strong growth, driven by the rising demand for data, analytics, and risk management solutions. Beyond S&P Global, there are also companies like Netflix, Microsoft, and Visa, all of which combine defensive qualities with high growth potential. At the same time, their business models are also relatively easier to understand, making them attractive options for those who want both defensiveness and long-term upside without the complexity of trying to decode an entire conglomerate. Anyway, that's just my thoughts. But what do you think? Is Berkshire Hathaway a good investment? Do let me know down in the comments below. Like, share, and subscribe as I'll be posting new videos every week.